All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, welcoming you to this special report, which we have now a pretty well history track record of doing every time the Federal Reserve releases its guidance, and then Fed Chair Jerome Powell goes out in front of the media. We dissect it for you and hopefully digest it and make it understandable for you with the help of fund manager and Fed-watcher Axel Merk. Axel, how are you doing today?
Very well, and I did not fall asleep, even though that might have been Powell's goal today.
I actually found this a little more interesting than it was sold, because it was sort of sold like, look, he's not going to do anything. It's a big nothing burger. Don't worry about it. But I felt that he took, and sorry, folks, I should say right up front, the Federal Reserve did not change its policy rate. It did not change the pace of QT. So it literally is not doing all that much. But he took pains to say that, quote, risks of higher unemployment and higher inflation have risen. And he seemed to take, several sort of subtle but deliberate jabs at the current administration saying, hey, you guys are making things a lot more uncertain. And as a result, I don't want to feel pressured into doing anything. So Trump, I know you're blowing up the headlines, telling everybody I should be cutting rates, but I'm not going to do anything until I see how this thing plays out further.
Yeah, and he had a script today and the talking points, and he repeated them numerous times. And it was kind of saying, oh, we're in a comfortable spot and we can afford to wait. He also used the word, I don't think we know. I don't think we know, several times in different variations. And one of the traditions I think we have here is that we disagree with what Mr. Powell says. And so I will just say the outrageous thing that I disagree with Powell here. Obviously, the Fed doesn't quite know what's going to happen, but they know that they don't know. And that makes all the difference, right? Usually, the Fed is boasting about what the economy is going to do, and of course has a bunch of qualifiers and caveats and so forth. But normally, there is a cognitive bias that the folks at this debating club, as I like to call it, have. And then they'll test the economic data that comes against it, and we argue that they're right, they're wrong, they shouldn't do this. I allege that they don't have a framework. Whatever it is, what's different today is they know that they don't know. And that they know with a very high certainty. And that's hugely relevant because, as many market observers have noted, I think we've talked about it at some point, the Fed is no longer the most important game in town right now. Mr. Trump is, tariff policy is. Jonathan Ferro, he's an anchor at Bloomberg, he even said that Trump dictates what the Fed is going to do. We can talk about that in a bit, but more relevant here in the short term is that we know the Fed will not do anything in the short term because they're not supposed to do anything in the short term, because they know that they don't know. And as abstract as that may sound, that is actually a lot more certainty than we usually have with the Fed. And maybe at risk of doing too much Fed talk here myself by giving here this double negative, it means that the market rightfully focuses on other aspects, right? The market rightfully focuses on what might happen to tariffs and really puts aside of what the Fed is doing. And Powell is correct, right? They're slightly restrictive, less restrictive they had been. And yes, we can argue whether they're going to be too restrictive or not, but they really have their hands tied right now, and they know it. And so in that sense, there was a lot of information given out that they confirmed it, right? I mean, okay, if they didn't have a presser, we would also know that they don't know. So in that sense, I stick to my word that I've mentioned on this program, that I think maybe they're better off not saying anything. But right. But it was in the sense when he says, I don't think we know, I think he knows exactly that they do not know.
So let me ask you this, Axel, and I'll acknowledge your perennial comment that criticism of the Fed that it does not have a framework, which leaves it to kind of flying by the seat of its pants. When you have greater uncertainty, right, to your point, when you know that you don't know, right, what would be the more responsible action here? Would it be to do nothing and wait until there's more clarity, as Powell is saying he wants to do? Or would it be to sort of err on the side of, well, because I can give equal weighting to good or bad, I should be a little more, I should err to the side that if something bad happens, I'm kind of foaming the runway?
Well, historically, let's keep in mind what the Federal Reserve's mission is. The Federal Reserve is not to make you or me feel good, to have something to talk about. The financial stability is really their core mission, even more important than what happens to inflation and whatnot. And so when they don't know what else to do, they will check, are credit spreads blowing out, right? Is there something really systemically important happening in the economy? That is when they can act quickly. Otherwise, they are this debating club that reacts slowly. Now, context, of course, matters. Tariffs are a supply shock. The last time we had a supply shock was during the pandemic. Lowering interest rates when faced with a supply shock gives you inflation. It's not a good idea, period. Of course, if there's a capacity for the economy to grow when you lower interest rates, that's fine. But let's give Trump the benefit of a doubt and he can retool the economy. That's not going to happen overnight. And so you cannot inject a big stimulus to an economy that's just faced with a supply shock. Supply shock means fewer goods are coming in. If you increase the demand for those goods with lower rates, guess what? Prices are going to rise. And so that's why the Fed is just such a tough spot. Now, could you argue that they're already too restrictive? Maybe, but let's keep in mind that inflation is still high, not exactly at the target. They know from history that once inflation is high or had been high, it is not linear. So that gives them a reason to pause. And then maybe most importantly, the gauges that they have are completely useless right now. First, they destroyed the gauges that they historically had after the financial crisis. They can't look at many market indicators. Then the second one that we have today is, you saw that the GDP print was negative. Well, the reason the GDP print was negative because imports surged.
Right, now, because everybody was front running.
Yeah. So for those old enough, remember Y2K, the pencil pushers in big business said, oh my God, we all need to buy a new computer in 1999 because maybe our computers will not make it from December 31st, 99 to the year 2000, when the two-digit representation on the computer switches from 99 to 0. And it's not that things blew up, but when you tell every enterprise that's out there that this could be a problem, they all rush to fix a problem that might not have been there, but nobody wants to be responsible that your pacemaker stopped working on December 31st, 1999 because of that Y2K rollover. And so guess what? In early 2000, people realized we don't need to buy any computers, right? We got everything already. And so there was a pronounced economic slowdown that then helped exacerbate the dot-com bust that we had. And so similarly, now with this back and forth on tariffs, the numbers are completely distorted. We had a lot of imports. Well, GDP print is negative, but does that mean the underlying economy is weak? Nobody has a clue. And it's not helpful, of course, for the data nerds to say, okay, tariffs are on this week, they're off next week, now they're high, now they're low. It's utterly useless to look at the data. By the way, fun fact, we've talked about him before, Kevin Warsh, who had restrained, he and Bessent, the Treasury Secretary, have been credited of talking to Trump to not fire Powell.
Powell.
Yeah, Powell, yeah. Kevin Warsh is somebody who has given speeches that the Fed should look at more real-time measures, including AI, to have gauges on how the economy is doing. That we have all these economists and whatnot. Let's use them for something more useful rather than crunching these backward-looking data, looking at some more real-time data. And I don't know whether Trump has listened to any of that, but that might make Kevin Warsh even more appealing to succeed Powell, because when the data are literally useless that we're looking at right now, having somebody who at least has an appreciation for real-time data might make sense. And so then if you have a sense of what's happening, you might be able to act, right? But right now, not only do they not have a framework, and I say that in part is when Trump was elected, the folks at the Fed, when they gave the economic projections, they were all over the place because they just gave their personal biases. I mean, they're human beings of what's going to happen under Trump. And that's, I mean, it can work, but it's not a preferred or efficient way of working. And so we are in a situation where they are slightly restrictive. Larry Summers, the former Treasury Secretary, who's been quite outspoken these days, I think it was him who said that he doesn't know where the neutral rate is, but it's almost certainly higher than where traditionally people thought it was. And so for all those reasons, the Fed is not going to budge much from where they are right now. I mean, you can argue about 25 basis points or 50 basis points, but they're not going to have a substantive change in the policy.
Yeah. Well, I mean, a lot of people would welcome what Kevin Warsh is advocating for, because the Fed is, chronically criticized for driving in the rearview mirror, right? Looking at old data that is lagging. Obviously, adopting some new, more real-time data sets would probably help combat that. I haven't heard Kevin's name in a while. So I'm just curious, is he still, do you think, in your opinion, one of the front runners for the Fed? And if so, who's his competition right now?
There is no competition. He visited Mar-a-Lago several times in recent months, and that's in the public record, and was quoted in the media as advising Trump on some issues. If there's something that speaks against him being the next Fed chair, I think it's because he has been in the media. For those who are nerds and like me who actually look at the stuff in detail. But yes, he's been talked about and been quoted as somebody who's a favorite by Trump to succeed Powell. The ironic thing here is, of course, that Kevin Warsh, he's a former Fed governor, who don't know him, is considered to be rather hawkish. Yeah, I'll just leave it at that.
Okay. Well, and just to tip your hand a little bit further, if I can, you actually would be pretty happy with that nomination, wouldn't you?
Well, for full disclosure, I know him personally. I am not going to say that we are quote unquote best buddies, but I have met him on several occasions, and I have greatly appreciated his views and insight. And to just reserve the ability to criticize him should he become the next Fed chair, it is, of course, in some ways much easier to be here, right, and to criticize the Fed than to actually do this job. I have always sought the dialogue with policymakers, especially on the monetary side. And unlike what some people say, I actually think that they all mean well, want to do the right thing. It's just that the system is set up that the results aren't all that great, which shouldn't stop me from criticizing the current Fed. They have this 5-year review ongoing, and it's not been a transparent process. They haven't admitted the mistakes they've made in the past and whatnot. Kevin Warsh, if I just can expand for a minute, he is in the George Shultz sort of footsteps. That's how I think he might not disagree how he sees himself. And if you think about that quote unquote old school approach, is you project what your intent is and you follow through on what you say. And that goes a long way towards having a strategy, right? And you kind of set the parameters there. The economists talk about reaction functions, right? You talk about that much more. Now, clearly, there's a Fed talk that Greenspan talked about that you want to be a little bit confusing and whatnot. To be seen whether this happens. But yes, of anybody that I know that is a potential successor to Powell, I would much rather see Kevin Warsh than many other people.
Okay. Well, we won't have that long to wait, right? I mean, about a year now, right?
And by the way, that's one of the key reasons why Trump was talked out of firing Powell, because it's the risk reward on that is just not worth it. Because once you fire one person, the market realizes you can fire the next. By the way, we should, I don't know when we talked last,
and
because
firing
that was
hard,
before.
Just to be clear, too, firing a Fed chair is hard. It's not an easy decision.
Well, it's more than it's hard. It's extremely destructive to the markets. And let me expand on that, because that's, I don't stop me if I've talked about this before with you. A Federal Reserve that's independent, and that's regardless of whether we agree or disagree with the policy that they actually have, it leads to lower interest rates, lower borrowing costs, because a Fed chair can move the markets with a few words.
Right.
If those words get second guessed, the Fed needs to take stronger action, both on the positive side, on the hawkish or on the dovish side. And so if there's credible interference, and the emphasis on credible, it is bad. Now, keep in mind, using the Fed as a punching bag is an old tradition. Trump might have his unique style, right? But it is an old tradition. You deflect responsibility onto the Fed because nobody understands the Fed. The Fed, these are the big bad money guys. And so it's their fault, no matter what.
Right, and the public can't remove the Fed.
Yeah, and that's political speech, and good for Trump if that's what he wants to do. It crosses the line when it becomes credible. And when Trump was most forceful, you saw that in the market just a tiny bit. I first didn't see it, and somebody pointed out to me. The place you see that is in long-term inflation expectations. That's where you see it first. And I mentioned to your audience here before, nobody knows, of course, what inflation will be in 10 years from now, but they're market-based measures. And when they start jumping, when they start being unanchored, and I'm not talking about when inflation will be in the next 2 or 3 years, but there are measures that say, some of your audience knows that, like 5-year expectations, which means theoretically, you jump 5 years into the future and look at the annual inflation 5 years down the road. Right. A very theoretical measure, but if that measure were to go haywire, that would mean that we are moving more towards a Turkish central bank environment, right, where inflation can be dramatic and so forth. And so there was a tiny uptick in that in some of the most aggressive statements that Trump had made. Noteworthy, but nothing dramatic. And so if Trump were to quote unquote fire Powell, it would be extremely destructive, because you're substantially increasing the odds that there will be credible interference going forward. Yeah. And it's going to create more inflation. It's going to increase the cost of borrowing, and that is why even if you quote unquote want the job, and you've got to talk sense into Trump, because he might not appreciate those nuances.
Right. You want to get it honestly, right? Yeah. You don't want to get it
honestly, and so. But similarly, of course, it is very important who the next chair is going to be, and the market will watch that carefully. And somebody like Kevin Warsh, in my assessment, has the credibility, because he's known as a hawk and because of his history, that he will retain that independence. And again, that is completely different from whether you or I or somebody else believes that interest rates should go up or down tomorrow. That's separate. And so it's very, very difficult, of course, to differentiate those things. But for the markets, it's an incredibly important difference.
Okay. Great distinction. And I do want to thank you in advance for when your best buddy, Kevin Warsh, does become Fed chair, that you'll be able to get him for these post-Fed breakdowns here. So
don't get me in trouble. He might be watching your program, so don't get me in trouble for giving me labels that he says not so fast, buddy.
That would be wonderful. I will pull the curtain back a little bit and let folks know I did reach out to Kevin Warsh and his people. Gosh, this is probably like, I don't know, 8 months or so ago, maybe even a little more. And they said, "Oh yeah, we could maybe work something out with Mr. Warsh." And then I never heard back from them. And my guess is because he got. Well, my guess is the further he got to meetings at Mar-a-Lago, he probably just didn't want to screw anything up, right? Don't let me go into a small podcast and skunk my chance.
He's also old school in that sense. He doesn't speak much, and when he speaks, he wants to make an impact. And so if you were to get him on, then congratulations, because he does not take many speaking engagements.
Okay, well, yeah, I clearly haven't gotten him on yet. So, all right. So a couple apologies here for folks. Looking for this comment by Mar Gator, who here we go. Nope, that's not the one. Who was asking me to run a poll here. Hey, Adam, do a poll and see how many people think the Fed should have cut. I'm not using my normal for these live events. We use a different software program that, as far as I can tell, doesn't allow for live polls. So let's just do one in the comments section, folks. Just give your answer whether you think they should have cut now or not.
And let me tell you why that's a really bad idea to have that poll. No,
okay.
By all means have it. But of course it doesn't matter whether the Fed stays, cuts, or raises. It matters what their trajectory is. Like, what is their plan? How do they look at things? The markets, the current rates are, of course, the anchor of the risk-free rate, what is by definition or regulation the risk-free rate. But the yield curve around it, the financial conditions, is what matters. And so people are always so saying, "Oh, what are the rates today?" I mean, just look at your mortgage rates, right? They haven't budged, and it's that stuff that matters much more than what interest you're getting on your current account right now. Clearly, it's of interest if they were to cut rates and whatnot, but it is why I pound this table on this criticism that the Fed doesn't have a framework, because it is just as it is important for borrowing costs not to get interference from the executive. Borrowing costs are lower when you know the rules of the game, and there is the eternal tension on the Fed on whether you're rules-based or discretionary. And even the quote-unquote rules-based folks want to have some discretion because the rules might just get it wrong, because I know better than the rules do, right? Whereas in the strict interpretation of the rules, you publish the rules and everybody knows what's going to happen. And so in the current environment, let's just assume for a moment we had a published formula on how the economy how the rates would be. Odds are, of course, that we would get some jolting around based on the economic data. And some folks that favor discretion would say, "Oh my God, that's all bad because we don't really know what the economy is doing." The reason why that is acceptable is because we know what the function will do and how future data will be incorporated. We heard that are you still the same as before you just went off the camera? Because we heard you switch around. That's not your twin?
They couldn't see it, but you just outed me. I had to get another piece of paper off the printer.
Yeah. So the knowing what the reaction function, as economists like to say, is super, super helpful. And the Powell Fed hasn't done that. And we haven't done that really since Bernanke, right? Because they were just constantly in crisis mode. And that is something that we should get towards, but the odds are low. A Warsh type of Fed might get us in that direction. The challenge is, once these fellows are in power, even if they talk the right thing in theory, once in power, they said, "Yeah, I like the rules, but now I got the power, so maybe I can override the rules." That temptation will always be there.
Okay. Well, look, just eyeballing the results here in the live chat, looks like the majority of people who are casting their vote are saying the Fed should not cut. let me ask you this, Axel. So, I mean, I can easily make, I think, the argument on both sides of cutting or not cutting, right, from the data. And I know in your world, hey, you want to have a framework, right, and everything that everything plugs into. But if you're asking yourself kind of where's the economy headed, right, and what should we do? You know, on one side, you've got the inflation numbers being stickier than the Fed would like, and you've got tariffs, right? So you're thinking, oh gosh, all right, you know, prices could be going higher, or at least staying higher for a lot longer than I'd like, right? And that would obviously say don't cut, right? On the other side, you know, the most recent inflation data is, depending on which one you look at, but shows inflation is, you know, still moderating, right? It's trending in the right direction, if albeit slowly. Tariffs generally, we don't know for sure, but they're generally like a one-time price shock, right? It's not like an inflationary impulse that keeps pushing inflation higher and higher. It's a re-rating, right? And also we know that a lot of, well, we're being told they don't even want to impose these tariffs in the long run, right? That hopefully they're going to be taken away in exchange for a better trade deal. But then if you look at the rest of the economy, and a couple reporters asked Powell this directly, you know, look, we're seeing all the survey data go to hell in a handbasket, right? You know, all the CEOs don't know what to do, and so they're not making capex investments, and households are worried, right? Housing market continues to experience more pain. You know, companies are not hiring people nearly as much as they used to. We're not at the super mass layoff stage yet, but we're seeing a lot of layoffs continue to be announced here and stuff. And so the question is sort of like, you know, they've asked him, is how much more pain do you need to see to determine it is time to act, right? And I can appreciate that Powell is kind of caught between those two things, right? I guess, do you have an inclination one way or the other? And, you know, let's say the Fed continues to sit on its hands and the tariffs, you know, largely get removed because of better trade deals, but the economy does start to really seriously fall into recession. Would this be another case of the Fed having waited too long and being behind the curve?
Well, let me give you a few different answers. The first one, to just circle back to what I said before, if we had a rules-based Fed, I don't think they would go over to completely automatic setting of rates. But one of the things we would see, and we might well see on the new Fed chair, is that as part of both the deliberation, but also the communication, you're presenting a whole bunch of different of these rules-based systems and say, okay, if we had a rules-based system, these are the 5 rules we look at. This is the output that these 5 rules give. We decided on this result because of X, Y, and Z. Because we don't like any of the rules, because they don't apply, because 4 of the 5 say it, or whatever it is. And so in doing that, you can lean in that direction, and you would have a reasonable way in which to answer your question of whether
and
you
this is
should
the
lower rates or
framework
not.
that you say. You should have a rules-based framework, yeah.
Yes, exactly. So even if you don't strictly adhere to it, communicate that more. That can be done in a heartbeat, right? And they should do in their 5-year reform. The other answer to your question is there is no good answer. And that is, the Wall Street Journal wrote about it. Lowering rates is, even in a weakening economy, is not necessarily the solution. I mean, let me read you the addition here in the Fed statement. The committee is attentive to the risks to both sides of its dual mandate, and then that's new, and judges that the risks of higher unemployment and higher inflation have risen. And so when the risks to inflation rise, you do not lower rates, because then you're signaling to the market that you don't care about inflation, which then becomes a self-fulfilling prophecy. And so their hands are tied. Now, will they be too late? Almost certainly, because they have to be reactive. The difference is that this time around, they don't have a choice. Whereas in the past, they've had a choice. But because of their lack of framework, because of where we are on inflation, because we are on tariffs and whatnot. And then let's keep in mind, I alluded to Jonathan Farrow at Bloomberg. He suggests that that Trump absolutely controls the Fed right now, and he looks at it a little differently. He says, let him put in place tariffs that cripple the economy. The Federal Reserve cuts rates by 100 basis points.
Mm-hmm.
And tomorrow he says, just kidding,
Right.
the will rates, and so he can force the hands of the Fed quite easily. And so
wouldn't shock me if
and
that
also
was
we
part
talk
of the
about
strategy here.
what precisely, but the one thing we haven't talked about so much is the carrots, right? We talk about the stick tariffs. I mean, there is this whole other theme happening here: deregulation, tax reform. Besant, he said that if you build a factory in the U.S., you can expense 100% of your investment the first year, including the cost of the building. We'll see whether that's going to come. But there are tools available that the executive seems to be not shy of using or fostering that could give this economy a boost.
Right.
And so you just
and remove tariffs at the same time, or at least make them moot, right?
Yeah,
Which is that you want to avoid the tariffs.
So,
build your
so
factory
you
here.
literally have no clue. Now, of course, luckily you're talking to me and I have a crystal ball and know exactly what's going to happen. My baseline, now that I've thrown all humility out of the window,
Yeah,
my
that
baseline.
gunshot you heard, by the way, was your compliance person just offing themselves in the next room.
Yes, my baseline is that Trump is serious about trying to rebalance global trade. He wants more production in the US. He doesn't like trade deficits in goods. So my baseline is that he would like to have a 10% baseline tariff on everything. Everything above and beyond is negotiable. Now, it doesn't mean that he can't negotiate the 10% away. Apparently, there were rumors, if you gang up with me against China, then I'm going to give you a further break.
Right.
And he is not. He is practical and pragmatic. But that is the baseline. Now, if you take that as a baseline, and tell me if we talked about it last time, it has profound implications for the plumbing of the global financial system. And that is something the Fed can and should take into account. Not that it makes their life any easier, it makes quite the opposite. And if I may, I'll expand on that. I think by now everybody has heard this example about the trade deficit consumers have with Trader Joe's, with the shopping center, where when you buy goods, you give them cash and you get goods, and oh my God, there's a trade deficit with a supermarket. Right. What people don't talk so much about is if one were to impose a trade balance, the supermarket would get less money.
Right.
And that applies to the US as well as a whole. When you throw a wrench into global trade, financial flows are impacted. It means deficits in the US will need to be financed more domestically. It means there is a natural increased pressure on the Federal Reserve to keep rates low. It's not a coincidence that this happened. There is an incentive to get your deficits in order because of that. And of course, DOGE does some of that, but fixing entitlements is really the big issue.
Right.
Foreign governments, to the extent that they buy treasuries, are incentivized to reallocate their reserves or put future reserves elsewhere. So there are profound implications for higher borrowing costs. And it's not a coincidence that the price of gold has been reaching new highs. It's because of that changed plumbing in the world, right? And so and going back to your question, what the hell is the Fed supposed to do about it? They can't do anything about it, right? They're on the receiving end of that. If the pressure were to become too high, we know from Mario Draghi that when push comes to shove, right, they'll do whatever it takes. But until then, they have to be stoic, and they just can't do anything. And it's part of this thing that the market focuses more on other aspects, because the market realizes it's not the Fed's job. I mean, historically, we talk about monetary and fiscal policy. Well, now executive policy is a third variable in this game, and the Fed is just subordinate right now.
So great point. I got a couple of sort of add-on questions here. One, based on what Jim has said here, and I've heard that this is truly indeed the case, that Scott Bessent, the Treasury Secretary, and Powell have a weekly breakfast. How much of this is the Fed truly being, completely impotent and, on the receiving end of this, right? And also, just trying to be independent, and I don't want to show that I'm influenced in any way by the administration. And how much of this is a coordination, maybe negotiated largely behind the scenes, between the Treasury and the Fed?
Well, the Treasury and the Fed should be talking. One of the side effects of all these laws to keep records and everything is that certain discussions just don't happen. You can't have several Fed governors in the room without record-keeping requirements. And so you have these one-on-one conversations because they can be off the record. They can be very helpful. It makes no sense when the Federal Reserve does QE on the one end or yield curve twisting and Treasury does something else. They need to talk. That doesn't mean the Fed is going to raise or lower rates because of what Mr. Trump does. And indeed, at the press conference today, Powell was asked whether he's ever talked to Trump, and he said no. And then he made it absolutely clear that it's not for him to reach out to the president. And that's at least his perception. He can't say it has never happened in history. He probably realized it has happened before. But the other direction, sure, if he's asked to talk. And yes, there are channels to do that with. And the Treasury Secretary is absolutely the right channel to do this with. Treasury needs to issue securities, right? And there are things that need to be coordinated. That doesn't mean that monetary policy gets coordinated, right? And so obviously there'll be plenty of conspiracy theories as to, oh my God, they're all in it together. But they understand the importance of their respective institutional roles. Now, if you had a different Treasury Secretary or a different Fed Chair, I might give you a different answer. Bessent, by the way, for those who don't know, right, he was part of breaking the Bank of England. He understands currencies, right? He understands monetary policy. And so he is a closet gold bug, by the way, as well. Not so closet anyway.
Not even not so closeted, yeah.
No, not so closeted. And by the way, for those who don't know, when the executive order was issued on strategic minerals, gold was elevated to a strategic mineral. And so this is all on the carrot side, right? Reducing permitting times in the federal bureaucracy type of thing. And so there is, but the fact that they're talking is very helpful.
Okay.
And by the way, go ahead.
I was just going to make a commercial. So on the topic of things that are being done right now to deregulate mining and access to domestic strategic minerals. If that's something you're interested in, watch tomorrow's video with Rick Rule. It's coming out at 11 a.m. in the morning. We get real deep into that.
That Rick is always interesting. And by the way, one more thing on the rules-based thing. Hope people are as excited about rules as I am. Tomorrow will be a tribute to John Taylor. He is the inventor of the Taylor Rule, which kind of brought the rules-based system to the forefront. He is close to retirement, and so tomorrow at Stanford there's going to be a tribute to that, followed by an annual conference, monetary conference at Stanford. You know about it, Adam, because I have said no to some conferences you invited me to speak at that you have hosted, and I said, nope, I'm going to attend that conference as much as I like you, but I think there's nothing more exciting than academics discussing monetary policy.
Well, I can't blame you. And boy, if you get a chance to talk to Mr. Taylor, please.
I mean, think about it. Other people watch stupid games where people play with a ball in a field. I mean, I have my dog chasing a ball. Why would I do that when I can listen to Mr. Powell and the like?
Well, I mean, here we are talking about really wonky developments for the Federal Reserve, right? Monetary policy. And we've got over 2,700 people watching live at the moment. So,
by the way, Powell is not going to be there.
Person that finds this interesting.
I don't think Powell is on the speaker list, but yes.
So to something else you said earlier too, and then folks, if I'm going to try to reserve some time here for you to ask questions of Axel as well, so get ready for that. rightly so, because I think the communication hasn't been stellar. The Trump has been criticized for, you don't even understand global trade, right? Like there are benefits to having a trade surplus, right? A trade deficit by definition is not a bad thing. And you gave the example with Trader Joe's, right? And I don't think, and I'd like to get your opinion here, I don't think that Trump or Besant are saying hard line, no, every country's got to get rid of its trade deficit with the US. I think what they're saying is that a number of the trade deficits are larger than they should be, perhaps in the case of China, much larger than it should be, because they have protections against getting our goods in their country that we think are unfair, and we'd like to dismantle those, right? Now, they're not necessarily saying we have to have even Steven trade balance, because at a lot of times it just wouldn't make sense. So do you agree that that's kind of gotten snarled up in the discussion here? It's sort of a false argument?
Well, like anything in politics, it becomes political, right? I mean, there is to suggest we would like to produce more in the US, I think that's a perfectly reasonable political position to take. You can take the extreme Friedman scenario saying, hey, we do all what we do best and so be it. There are some defense reasons why you want to produce certain things at home and so forth.
Sure.
That said, the question is, of course, why do we have these deficits and what can or should be done about it? And I alluded to the deficits being financed. Well, one way to reduce a trade deficit is to get your fiscal house in order, because these are a question of math more than anything else. These are equations that need to balance out. And so one way to rebalance global trade is to get that back in order. And it was, I think, de Gaulle already who said or suggested that when the US went off Bretton Woods, that gives the US a license to print money, and they'll print all the money to have some unlimited spending, and that's going to create huge imbalances, right? And when I talk about the plumbing changing, this wrench thrown into trade is a shock to the system that adjusts it, but it also it reduces, if not eliminate, the exorbitant privilege the US has. And so there's an immense power in being able to have an unlimited spending power. The problem is, of course, that politicians abuse that power and create ever more spending programs. And so having a pushback against that is reasonable. I happen to think that carrots are the much better approach than sticks. And so I happen to think that you need to work on deregulation. You need to work on tax incentives, and often neglected, on fiscal sustainability. The reason why that's a huge factor, if you want, part of this reindustrialization is code for longer term investments. Over time, we invest in Facebook because you can click on the cat video and get joy out of it. Whereas if you build a nuclear power plant, it takes forever. And so if you want to provide incentives to make long-term investments, one of the ingredients, aside from reducing the permitting process, is that you need to have the fiscal house in order. If you think that the fiscal deficits are unsustainable, why would you put money into that country long term, unless you can get very high returns in the short term? Right. Because the interests of the government are not aligned with yours as the investor. Right. It means that the government has an incentive to create inflation, the government has an incentive to create higher taxes or find some other way of expropriating you. And so it's kind of the basic stuff you need to fix. Using it with tariffs doesn't work. And you saw that Trump won, right? Renegotiated NAFTA. Well, guess what? China and others moved all their production to Mexico. And guess what? When the tariffs were put in place now, or the threat of them, Apple flew hundreds of tons of iPhones and other stuff to, I think, India or wherever country it was. And China, I mean, look at the war in Ukraine. Russia is able to get all its stuff. But suddenly the way that these goods make it are different, right? Businesses have an incentive to sell to you as consumers. They will find a way. Might get more expensive. Now, does it mean you shouldn't use tariffs as a negotiating tool? Godspeed, right? If that's what he feels like and wants to do, by all means. But in order to fix trade, you need to work on the carrots more than on the sticks.
Yeah, and I don't disagree. And to this administration's credit, the list you mentioned there, tax reform, deregulation,
absolutely.
et cetera, even fiscal restraint, this is part of its program, right? In a way that it hasn't done it.
Except, I mean, I can speak from this place easily, right? Fiscal discipline, Doge is nice, but you need to have entitlement reform type of thing. And the other part of it is, of course, is a key ingredient to invest is clarity. You need to know what regulations will be next week, next month, 5 years, 10 years from now, right? Mm-hmm. And the more you do with executive order, the riskier it is. And by the way, I don't think it's a coincidence that the Trump administration is dismantling entire departments, because that increases the odds of the regulatory changes being permanent, right? And so I, as critical as I am of the idea of tariffs, I'm not disagreeing that you can achieve many things with the sort of tools you have. And I guess many people will give them the benefit of the doubt and say, yeah, whatever. I see my role more as an investor, and most of the audience knows with the many talks we've had, we manage over $2 billion in gold and gold mining. And so I should be very thankful for this quote unquote changing of the plumbing of the global financial system. But it's I wouldn't do what I do if I didn't think the risks associated with the trajectory that we are on, which isn't new, by the way. Trump is just a symptom of the times we're in. They get me to be allocated the way I am.
Okay. All right. Well, look, again, end of the day too, it all comes down to how they can say they have all these policies they want. It's all going to come down to how effective are they in getting this stuff both implemented in the short term, and to your point, then enacted in the law and preserved and all that type of stuff. One quick note on the fiscal side, and then we'll move on. I was listening to Bessent being interviewed yesterday, and he was asked about, might even been this morning, and he was asked about, plans to get the deficit down, how much by when. And he said, well, it's kind of a double-edged sword, right? You have a lot of this spending that's supporting the economy, and if you cut too much too fast, you can actually deliver a shock to the economy. And so it sounded like their plan was to walk the deficit down from 6% of GDP to 3% of GDP, which is more of its historic average, over the next couple of years. So it's not that they're trying to get there by the end of 2025, which was interesting because I hadn't heard it clarified that clearly before. And I think a lot of people had expectations, realistic or not, that they were trying to chainsaw it in half, tomorrow.
Yeah, well, once you're in power, you become kind of a little more moderate. But the facts,
and it could be too a walk back. Yeah,
and of course, then there's a crisis, and suddenly you spend money again. But I think the relevant for a global asset allocation is that in the US, we have a bias towards fiscal constraint, and got to contrast that with Europe in particular. Germany finally got its new chancellor on the second run, I guess. And in order to get that coalition together, he decided that we need to spend 500 billion euros on defense. The coalition partner said, well, we need to spend a little bit more money on infrastructure. He said, okay, let's tag on another 500 billion. The EU wants to spend over 500 billion as well, other European countries as well. So in Europe, the fiscal policies are rather expansionary. And so that is going to create its own set of dynamics as well.
Well, it's going to be interesting to see how long that lasts for, right? Because one could make the argument that they've been fairly expansionary to date because the US was subsidizing some of the defense costs of these countries, right? There's an argument being made that, hey, the reason why a lot of these European countries can have such big social safety nets is because they're not spending all this money on defense. So I'm curious if in 2 or 3 years, you guys might get a lot more fiscal restraint than you've had historically. Not you guys,
Europe,
but the Europeans.
Just because I have a European. I keep my accent, so I'm considered an expert in the field of currency.
I know, but you're more American than I am, Axel. So
I don't know. I lived in California I've lived in the U.S. more than any other country, in California than more than any other state or country. Lived in California now for about 25 years.
Yeah.
Had my 30th wedding anniversary yesterday, by the way.
Pardon me?
I had my 30th wedding anniversary yesterday.
Oh, congratulations!
I'm getting more gray hair here and getting more established.
Please give my best to your better half. I won't mention her by name, but we should also let folks know too. Not only are Axel and I, macro peers here, but we are friends in real life, and we actually lived in the same town for a number of years. In fact, I think the house I rented was a house that you had rented. Next door.
Yeah, next door. And we'd once tried to recruit you when you were exhausted with your old life of having the high life, executive life, and you opted to then go on your own or with somebody else. But
I think it worked out well in the long run for me, but there were many years where I wished I had taken that door, Axel. We'll also let folks know too that we went to college together, and that's where you met your wife. You were a couple years ahead of me, and I think too cool to know me at the time. But I just want folks to know
I was many things, but not cool. That was never my middle name. No. These jokes about monetary policy, that is me. Those, for some reason, they never hit home with most other folks. So
that's about as cool as you get. Is jokes about.
That's about yes. I have jokes on monetary policy, and they weren't very different back then. Yeah.
All right. Well, look, as we start to wrap up here, thanks again for providing all your time here right after the Jerome Powell conference. Folks, as you have questions for Axel, please ask them in the live chat here. I'll just toss one out about gold because you mentioned it earlier, and obviously it's a big focus of you at your firm. So it does sound like you think that gold kind of is the barometer here of the fairly seismic change that is going on this year. Let me ask you this: is this change permanent or transitory? In other words, is gold finding a new level from which it will build over the coming years, or is this something that will be undone as the uncertainty begins to die down, hopefully over the rest of the year?
Well, let me again give you a few different answers. First of all, historically, I would say absolutely a barometer. And the reason is that gold has the least commercial use of any of the commodities. It's used as a store of value. I mean, there's jewelry use and some other use, but very little compared to silver already. And because of that, and I was just quoted again on that, it has the greatest sensitivity to the mania of our policymakers, I have said, and somehow people think that's quote worthy, but it's because it reacts so quickly. Because in silver, you already have to think about monetary policy, but also is the economy slowing down or not, and so there are other drivers. Historically, gold has been correlated to real interest rates. I talked about these long-term metrics, even if people don't know what those are. Those correlations have broken down, and so that happened to coincide with a weaponization of the dollar. I don't know whether that's correlation or causation. My cognitive bias suggests it might be causation. I published this piece about on merkinvestments.com. You can get the full analysis on the changing plumbing of the global financial system before Liberation Date. And so to just take credit for that I have a framework in which to look at these things. I'm not just trying to fit the story to something. I also believe that Trump is serious about what he's doing. And for those who, well, it doesn't matter whether you like Trump or don't like Trump, as I indicated, I think Trump is just a symptom of the time that we're in. It's not like in a few years, Trump is going to go away and we're going to go back to normal. We have created an instability in the system because we've neglected finance. We have had regulations that caused the financial crisis. Note, I say we had regulations. The bankers, of course, didn't do any favors to anybody by kind of abusing what they were given, but it is the politicians that provided the environment where this was all happening. And so we will go towards periods of greater instability. Ray Dalio kind of talks about the different phases society goes through. I'm more in kind of his camp about the instability. I have argued that kind of this piece and that's consistent with what he talks about, even though they're not exactly the same framework, that the stability we had through the global peace, relative peace anyway, since World War II, has come to an end. And so if nothing else, all of this means the cost of doing business is going up, right? Europeans spending a gazillion. By the way, if they spend a gazillion on defense, they don't have the infrastructure to spend on defense. A lot of that money is going to be wasted. J.D. Vance just gave some positive comments about Europe because he realizes they're not going to get these defense deals if they're not buddies with Europe, right? Because they like to sell the stuff to these guys. But we will get more populist politicians, not just in the US, and they're not all going to be on the Trump spectrum. They're going to be on the left, political left as well. Europe is going to get more populist politicians. And so I think that the reason why gold has been moving higher, I think it's because of that realization that the plumbing of the financial system is changing. The reason why there's no light switch is, of course, it's everything is diffused. What we saw in recent weeks was mostly just a volatility shock. We've had highly levered players. The world is changing rapidly through executive action, so you reduce your leverage. The actual change on how people allocate capital, especially on the institutional side, will take a while. We talk about gold. This rally is not driven by retail. We have not seen premiums of coins go through the roof. Those are other players, central banks, large institutions that allocate towards gold. To me, we have just seen the beginning of a major shift. Now, does that mean gold can't go down quite a bit because it's gone up so much? Of course it can. But to me, the reason why I started buying gold in the early 2000s, those drivers are firmly intact. And the key difference is that some of the fringe views, the views of the gold bugs, are moving more towards the mainstream. And that, to me, because the gold market is not liquid and fairly small compared to other markets, can create these rather outsized returns. And so I happen to think that this is a fascinating time to be in the markets. The fact that real lives are at risk and real wealth is at risk is, of course, another matter. And usually when we do well, it means others aren't doing too well. And let me just say, 2008 was a good year for us, and this year is shaping up to be a good year for us.
Okay. Believe it or not, I've only gotten one question so far from the live chat, so I'm going to ask it of you in a second. But before I do, let me just ask you one around gold miners, which is sort of an area of specialization for you, given that you manage mining funds. So gold tends to move first, and then the miners move, right? Miners have performed fairly well this year. It took them a while to start moving. Talking to Rick yesterday, Rick said if you look at like past bull market cycles for gold miners, by the time the cycle's over, they're up by like 250 to 300%. The sector, tends to be, at least the good companies. He said they've moved about 50% so far, which simple math means that like, 4/5 of the movement's still ahead of us here. Do you think similarly? And I guess one question here too is like, miners are sitting on a lot of gold in the ground, and if that gold in the ground continues to appreciate at a substantially faster rate than their productive costs, the outlook for these things just gets brighter and brighter and brighter, correct, on average?
Yes, but there are lots of caveats to that. First of all, the market has been valuing gold in the ground at an ever greater discount.
Right.
We are at valuations that are similar to a few years ago with substantially higher price of gold. And there are reasons for that. Without getting too much into detail, but the major mining companies, they produce about 5 million ounces a year. They haven't been adding enough ounces, and the there isn't enough gold in the ground that's been identified to replenish that quickly enough. And so in the last bull cycle, they overinvested. Then the market told them, get your act together. They did, meaning they underinvested. That means their balance sheets are in better shape and they have less leverage to the price of gold. Barrick, and I'm not going to make any judgment call on them, but they recently changed their name from Barrick Gold, dropping the gold, also changing the ticker symbol. And the reason is that in order for them to do the sort of projects they need to do at their size, they're getting more involved in these copper gold projects. These are massive projects, some in jurisdictions that are where you also don't have a 20-year visibility on the stability of your capital. And they're very difficult to execute on time and on budget. So that increases different dynamics. And it's part of the reason why last year in particular, the majors had been lagging. Now with the price of gold having gone up substantially year to date, they have moved higher, consistent with what you have said, that the money flows into the bigger ones. So last year, the juniors actually did quite well. And now the juniors have kind of floated higher a little bit as well, but nothing in comparison to what the price of gold suggests and relationship to the higher volatility that they historically have. Remember, these junior miners often don't produce anything or very little, so there are more options on the price of gold, which means they should have much more intrinsic leverage, economic leverage anyway. And so that upward move hasn't happened. Financing is easier than it was. The low point, by the way, and I think we talked around that time, I put that in the October of, was it 2 years ago, where Powell pivoted away from the higher for longer environment. And ever since then, the market has been pricing in that we are going to a more favorable environment. And incidentally, of course, having a slowing economy doesn't matter that the recession hasn't happened, it's that outlook. And so, and to kind of answer your question, in some ways I agree with Rick, and I'm sure you would, I mean, he can also be far more nuanced, right? But it does matter where in the space you're in. Just as a caution, I have to throw that out for my compliance, especially in the junior end. It's a highly speculative space. Not all these companies make it. And we like that junior space because we like to see more than just in margin expansion because of the gold. The junior companies, when we help them institutionalize, bigger players come in, the valuations tend to be higher. At some point, they get added to indices. All of that tends to be beneficial to the extent that these companies make it. And so we think that there is better quote unquote value in that space on the junior end.
All right, so we got to start wrapping it up here. I wish I could go on forever, but I've already used over an hour of your time, and I actually have my personal trainer session coming up here, and as folks who've been following me on Twitter know, I've got to keep that thing going. So last question asked here by Kieran O'Connor. If bond vigilantes turn on U.S. Treasuries, can they do permanent damage in these circumstances? So, we have seen the bond vigilantes return episodically over the past year plus. So if they, they wake back up and start pushing the 10-year yield back up, how much damage could they do, with sort of a permanent outlook?
Depends on your definition of damage. Maybe that's part of the solution, right? If the only language that politicians listen to is if the bond market forces them to get their act together. And we've seen that in Europe, if we know one thing, that politicians are fabulous can kickers. And so they can push that out quite a bit. I do think tariffs do change the game and push yields higher. We have seen that. Even though there's fear of a slowdown, yields have not come down. And so if you call damage that the borrowing cost is higher because of the current policies, yep. Is it attributable to vigilantes? I think we're giving them too much credit. To me, it's a question of math, how the flows are affected. But to just take the other side of that, or the same side, I guess, there's always talk about how central banks are omnipotent. And by all means, if there was a big mess in the market, you called it foam earlier, right? Central banks would do things. if the market really were to lose confidence, central banks are just zipping with a straw from the ocean. They are not omnipotent. The market is far larger than the Federal Reserve or any central bank's power. And so that's why if they were true vigilantes, we do have to take them seriously. The reason why the Fed policy works is because there's credibility. And that's part of the reason why there shouldn't be interference by the executive. Because that interference, the bazooka that we talk about at the Fed, works because there's credibility. Now, clearly, if you can print an unlimited amount of money, that is very effective. But there's only so much you can do, even as a central bank, should the bond market lose confidence. And so it is important that governments get their act together.
All right. So James Carville, he's still right that if you wanted to be the biggest boy on the block, you'd want to be reincarnated as the bond market.
That's right.
Yeah. Okay. I'm not going to ask this question. I'm just going to answer it. So Romeo asks, where do we think basically oil is going? And I'm just going to say, watch the Rick Rule interview tomorrow. We get into it, but just to give you the
that is fantastic. I'll defer to Rick. That is so. Let him get in trouble for giving a forecast that's wrong.
Yeah. Okay. Well,
I'll give him that any second. Yes.
Okay. Well, I will share the punchline.
One thing. Yeah. Sorry. One thing briefly on gold mining is very energy intensive, and so having lower oil prices is very helpful for the profits. It's about 20% of the cost. The other thing that's very expensive is labor. And when other commodities don't do well, there is more labor available. Now, there's never enough labor available for mining, but part of the reason we didn't see the sort of leverage in the miners the last cycle was because commodity prices were soaring, including energy prices, and the cost of labor was rising, and governments wanted to have more taxes. And guess what? The leverage on the gold miners was much more muted. The fact that there's much less attention on the miners is excellent news because that means these earnings can actually materialize.
Great. I'm glad you clarified that. And we are seeing in the earnings of a lot of these miners that, especially the majors, we're seeing some real blowout earnings. So
that doesn't guarantee that the market will appreciate it and reprice these assets, but the conditions are certainly there. Yeah.
You may get the earnings really going up, but the price might not budge, right? The multiple might not remain. Okay, but anyways, quick thing on the oil and gas. Rick thinks that they are, quote, insanely cheap right now. So he'll get into the details why in tomorrow's video. All right, Axel. Well, look, this has been great. I got to apologize to you. At some point in there, the whole chat went off the rails about my hair. I was futzing around with it, and anyways, we got a lot of hair-related comments there. So if you're reading through this later on, my apologies on that. Although I do want to give special props to the nice people who gave me some compliments on probably the aspect of my appearance that I am the most insecure about. So thank you, folks. All right. So in wrapping up here, Axel, for folks that would like to follow you and your work in between now and June, because that's the next Fed meeting, where can they go?
Sure. I think you do this finger pointing often. Here we go. At Axel Merk on Twitter is probably a good place to be. Otherwise, merkinvestments.com is our website. I can't talk about our products here. We manage about over 2 billion in gold and gold miners. You can learn about those things there. We have a newsletter there. Sign up. And of course, at Adam Taggart's wonderful program, should he have me on again.
Oh, of course, my friend. Well, thank you for agreeing to do this. And again, like I said before, we'll have you on after every Powell presser for as long as you are willing and have the stamina to come do it. All right, folks, I also put up the URL here to thoughtfulmoney.com. So if you want some help in figuring out how to position your portfolio based upon where the puck is headed, according to all the macro elements that Axel has laid out for us here, or if you want to take advantage of some of the opportunities to invest in precious metals that Axel has also laid out for us here, and obviously, go check out Axel's funds. But if you want some help in determining, what percentage of your portfolio you should put into that and what other elements should be in your portfolio, consider talking to a good professional financial advisor. If you've got a good one who's already playing that role for you, great. If not, talk to one of the ones that Thoughtful Money endorses. These are the firms you see here with me on this channel week in and week out To schedule one of those consultations, just fill out the short form right there at thoughtfulmoney.com. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with the advisors. It's just a service they offer. All right, Axel. Thank you again, my friend. Hopefully sometime soon we'll see each other in person, but in the interim, enjoy the event with John Taylor. I think you said that's tomorrow. Hope that's a good time.
Tomorrow afternoon, yep.
All right. And I will see you here in June, and everybody else. Thanks so much for watching.